Good afternoon. My name is Lucy Sendell, and I work with the Career Development Team here at the University of Chicago in Hyde Park. I'm delighted to welcome you to our webinar entitled, Your First Tech Startup, What You Need to Know. The recording will be shared with all registrants in the next few days. Today's speaker is Booth alumnus Stuart Schaefer. Stuart is a very brave man. This summer, he traveled 4,500 miles through 12 states with 2 teenagers. In addition to this intrepid journey with his kids, Stuart will go far to help close the deal. He was in Cali, Colombia, the self-proclaimed salsa capital of the world. Stuart went to his supplier to their weekly company-paid Friday night salsa lesson. It was his first salsa lesson, but they said, "It's easy. We've been doing this since we were kids." It turns out that this was a combination of aerobic workout, precision dance, personal training, and instructor-led punishment. It's one of the many entrepreneurial experiences where he learned it's better to think big but start small. Before I hand over the controls to Stuart, I just want to say thank you all for joining us, and stay tuned. She's all yours.
All right, thanks, Lucy. Well, welcome everybody. This is Stuart talking, and glad you're here. I have done a number of startups and now mentor and invest in startups as well. And folks are on all kinds of different stages of thinking about startups, doing startups, or just sort of interested in startups. So as we get started, I'd like to find out a little bit about who you are, and then I'll introduce myself. So I'd like to do a quick poll on and see who's on the line. So Lucy, would you queue up poll number 1, please?
Great. So if you could answer, I'll give everybody a couple more seconds. Oh, people are answering. Thank you so much. Okay, I'm going to close the poll in a couple of seconds. And we'll share the answers. Off to you, Stuart.
All right, terrific. Well, we've got the leading answers. I'm planning on founding a tech startup. That is usually the leading answer, almost any group I talk to. That's fantastic. And the second answer is I want to be an employee. I've got something for you in this presentation as well. And for the folks who are founded a tech startup, congratulations, keeping the axe sharpened. Welcome, and look forward to your questions at the end. And investors as well. So we've got a pretty diverse audience, and that's typical. A little bit from everybody, but let me first tell you who I am. My name's Stuart Schaefer. I've been doing tech startups for about 9 years now. I founded co-founded 4 companies. One I founded and sold. That's the good one. That took about 5 years, and that's pretty common for if you're going to have a success. I've had 2 who failed. They both lasted less than a year. That's also pretty common if you're going to have a failure. And the 4th one's still in progress. So well wishes accepted for that. I've also become an instructor and mentor for the National Science Foundation's I-Corps. That's the government's effort, oddly enough, to get a return on the $35 billion it spends funding 18,000 university teams inventing things. About 100 teams get picked every year to try and get the technology ready for private funding, and it's a really fascinating group to be part of. I advise VC funded startups. I'm a pitch competition judge. One of my favorite things, pitch competition judge, investor. Before that, I was at Procter & Gamble for 16 years, a variety of things, but I ended my role there in the Connect and Develop group, which is P&G's first effort to try and majorly source technologies outside the company. That's really what got me into the startup scene. I found that most people in companies or school have some sort of introduction, and then they start attending calls like this, and until they finally find the idea and the co-founders. So that's my background. Little bit of every one of you in there somewhere, and I'm going to just jump right in. First, I want to talk about the ecosystem, just very quickly. In my mind, there's kind of like 3 groups in the startup ecosystem. The first are the founders and the inventors. These are the first, second, third original partners, have equity, who come up with the idea, come up with a hypothesis for a business plan, and then basically drive everything else. Most of what I'm going to be talking about today is from the perspective of founders and inventors. And the reason I sort of use that perspective is those are the people who kind of drive the direction and the pace of startups. So everybody else, if you're an investor, if you're a service provider, you can't do anything until the founders move first. So that's kind of, if I'm not leaving you out, I will mention that, but it's going to be from this perspective of founders. And then also want to chat a little bit about early employees. Some of you folks, when you go through these quizzes, are going to look at what I'm showing founders go through and say, oh man, I'm excited, I got a great idea, but I don't know if that's for me. Fantastic. Early employees are kind of a little bit founder behavior and a little bit later employee, and there's kind of a big difference, but they're super important. And I'm gonna lump them in with founders and inventors because they help shape the company early on. Service providers, a lot of folks out there that can help startup folks. In order to really be a good service provider, you have to know what challenges startups have. So I'm not going to talk a lot about accelerators, incubators, lawyers, accountants, etc. I will talk about contract workers because that is how you should get a lot of your work done. They're not really employees, but there will be patches where you need help. So but I've lumped service providers together. And lastly, investors. You sort of go through the stages of investors. Typical ones are listed. And I'm going to talk a lot about strategic investors. Like, you can not only get money from strategics, so these are people in the industry, other companies, but you get advice on how to succeed. All right. So I want to take another minute or two and take you through some of the questions I ask folks. I get approached all the time from people in their 20s and 30s. I'd say once, twice, 10 times in a week is not unusual. People in their 20s and 30s, and then again, another group that's pretty active is people in their 50s. And they say, hey, I've got an idea, or I've got a partner, or I'm thinking about doing a startup. I feel like I'm falling behind, but I've got a good job. I don't know. How do you get started? And before I even start giving advice, I ask them 3 questions. And it's really to see if they're a founder or not. The questions are you thinking about and planning your startup every minute you have free? So, when you're running errands, evenings and weekends, mowing the grass, cleaning the house, are you thinking about your startup? You kind of need to be, because once you start it up, that's what you'll be doing. So if you should be doing that already. Secondly, are you saving for your startup and keeping your financial overhead low? So I ask them things like, are you thinking of buying a house, new cars? What are you doing for vacation? Are you driving to visit family, or are you, taking the cruise to Europe? You want to keep your financial overhead low. The rule is everything in startup land will take twice as long and cost twice as much. So keeping the financial overhead low is important. You need to get in that habit before you get in the startup, so that it's not such a shock afterwards. And then lastly, are you building networks of people? If you really want to do this, feel the desire, you can't stay away. So this call is a perfect example. You can check that box. And really, all of the above. What I'm worried about for folks thinking about startups is, are they getting their finances and their emotions in order to jump into this sort of super exciting, but in some ways kind of a little bit foreign ecosystem? All right. Now, just so I have an idea of where you're coming from, I want to take poll number 2, which is what kind of organization you're coming from. So Lucy, could you queue up poll number 2?
Okay, folks, let's start clicking. Okay, just a couple more seconds for those of you who are eating your sandwich. Okay, close the poll, and I'm going to share it.
Perfect. big company or small company, not a startup. That's my background, P&G. So I think you'll find a lot of this useful. For folks who have been in an existing startup, I'd love to hear you compare your experience to mine in the Q&A later on. So please stick around for that. Most of the time, I'm just going to assume that most of you are from school or a big company, and just proceed from there. Okay, so big companies, great places. I'm PepsiCo, P&G alumni, Booth Business School. Wow, amazing people, amazing skills, and some of those are going to, if you develop those, they will give you an enormous leg up on competition. And they'll just be obvious to investors and customers that you have these skills. So things like analytical thinking, project management, financial planning, cash is king. You'll learn that one way or the other as a startup land. In fact, you'll become obsessive about cash. But you've got the skills, then you're a leg up. Personal integrity. Big companies, it's really important to have personal integrity. It's going to get a lot more important. And there's several reasons for that. One is, if you want investment, the investor pool is not as big as you think, and they talk. So you tell one person, you got to be prepared to tell everybody. You're also going to be relying a lot on the goodwill of customers. They're buying from a company they never heard of, they don't know you, et cetera, et cetera. What you say and what you deliver really need to match up to a degree that maybe beyond what you've seen before. And last is employees. One of the toughest things in the startup phase is to keep everybody on the team motivated and on the team. Again, they're really relying on the founders' integrity that this will turn into something, and their early efforts, some of which are not paid sometimes, are going to be worthwhile. So you want to notch the personal integrity up and keep it going. Your networking skills, fantastic. You've got really good ones, keep it going, and the work ethic. Here's where things start to get really interesting, though. There's a lot of big company habits that will probably be poison to your startup. And if they don't kill it, they might cost years worth of time, tens of thousands of dollars, et cetera. And some of them are just things you just don't learn working in big companies. The biggest one is that a startup is not a smaller version of a big company or even a small mature company. A startup does not have a business model. You have an idea for a business model, but it's not a business model that has any validation to it. You have a product that you think you can produce, but you haven't produced before, et cetera. So the first thing that startups really need to focus on, the one thing in your control is, can you describe a business model and test it so you know it works, and validate that as quickly as possible before you start running out of cash. And of course, what I mean is find a paying customer. Peter Drucker, some time ago, before the startup thing got hot, said the purpose of our business is to find and serve a customer. So that part hasn't changed, but it's the intensity of doing it and the length of time of doing that that's different. A startup is really just a temporary organization. According to Steve Blank and others, the Lean Launchpad folks, it only exists long enough to find a scalable, repeatable, profitable business model. Once it's found that, it's not a startup anymore. It's a growth company. So there's kind of a rule of thumb when I'm a pitch judge or an investor. If a company's been around for more than 2 years since it was incorporated, I really start to wonder if it's not a startup, but is it either a growth company because they've got some early sales and they're starting to build, or they have no sales and they're a failed startup. So that's not a hard and fast rule, but a startup is really intended to be a temporary organization. And so it's one of the reasons, because it is temporary and you're not there's not a lot of cash coming in the door, it tends to be kind of an intense operation. And the focus is really just find that paying customer. You have a hypothesis on the business, you validate it by finding a paying customer, and boom, you're out of the startup phase. Good for you. That's where you should be. Folks don't know. They think they're building a large company from the beginning, and they want to have a CTO and a CFO and an HR manual before they even sell something. I got to tell you, I have launched businesses that I didn't have a website or a business card, but I did have a paying customer. So really, it's just a really different focus on this is a temporary thing. We're going to get through this as fast as possible. Second thing coming out of a big company, and you're probably not even aware of these differences, but first off is the people aspect of things. Picking co-founders. You have to think about co-founders more like people you're going to marry than just a coworker you're going to work on for a project. You may be working together for 5, 10, 15 years and probably more hours than you can imagine under many more stressful conditions. So generally speaking, co-founders, it's generally better to have one than not, especially if you're a technical and they're a business, my experience. The co-founders often are more robust combinations than one person doing everything, but not always. But if you're doing a co-founder, think of the relationship first and the skills kind of second. If the relationship's not there, maybe they can be an early employee, but don't think of them as a co-founder. One of the things that keeps startups from getting those early sales is the founders squabble over what the company direction is, and they spend all their time doing that and not calling on customers. So that relationship is really different. Mentors, hiring, firing employees, the hiring and firing, the jobs change all the time. The rule is on hiring, you don't need to focus so much on 20 years experience unless you have a particular need. If your invention is new enough, there isn't an industry. There isn't an industry selling what you're selling. So more like flexibility on the coming in, flexibility and eagerness, and maybe some industry experiences. Kind of ideal. Firing is when people are really going off the rails and they're really not with the business plan. You do that almost immediately. There is no other department to transfer them to. You're kind of it. If there's 5 of you, and they're not doing what they need to do, you don't have the luxury of carrying folks in the early days. But of course, talk to them, coach them first. So it's really very different. It goes a lot to what the need of an employee versus a owner's mindset. Seth Godin had a great little list in one of his blogs back in 2010 where he defined the priorities of a professional manager. This is his opinion, but it is completely aligned with my experience, that a professional manager and employees in order at the bottom of the slide are avoiding risk, avoiding hassle, gaining praise, gaining power, having fun, and number 6 is make a profit. So you can't assume that your employees or the person you're talking to at your customer is that their number 1 priority is making a profit. You're the owner, so that is making a profit is your number 1 priority, but their priority is avoiding risk in most cases. So when you're calling on customers, in my second startup, the one that was a B2B startup, I called on Fortune 100 companies. I was talking to professional buyers. I knew their number 1 priority was avoid risk, and buying from startups is very risky. So I knew that more important than the product, more important than the proposition, than the pricing, was I had to get over that hurdle of why buying from me is not a risk. And then they could listen to the rest of the thing. So you kind of got to reset your whole mindset on who you're talking to, and are they an employee or an owner? And you're the owner now, so you think, well, making a profit is good. Everyone will see that. Well, no, not necessarily. And then often, the operating in near panic mode when cash gets tight. I don't operate in panic mode that much anymore. I just sort of have this steady intensity about running out of cash. But it's just one of the things that comes up a lot in startup land. And it will drive you to focus, hopefully, on paying customers. And then the last thing about how you finance your project. A lot of folks think, if they've read a book or something, that, hey, I'm going to come up with an idea, then I'll go visit some investors, they'll give me some money, and I can build out the idea and visit some customers. That actually rarely works. Investors usually want to see companies that already have sales. And 1 in 100, 1 in 400 will actually get early financing, but most of them have to go build a prototype with government grants or their own money or family money, go try and find a customer on their own. And then when they bring it to an investor, if they've got some sales or at least somebody who looks interested, credibly interested, then then you can start attracting investment. It's one of the gaps I see is most common between inventors and actually serial entrepreneurs is inventors think, I've got an idea, I should just attract a lot of money, because it often isn't enough. Now, how do you get over that gap between having an idea and getting a prototype built and traveling to visit customers? Well, barter. One of the tools that is most useful for me, and everybody who's done this a bunch of times, is bartering. So you don't have cash, but you need marketing services. So you find a marketer and you go tell them what you need and say, I don't have cash. What can we exchange? Can I pay you later? Can I give you equity? Can I just, will you do it because of name recognition? If I agree to use you for the next 3 years, if I'm successful and commit to you, will you give me some free services now? The folks who can barter the best or have the best shot of just getting through that startup phase when cash is really tight or maybe not coming in at all. And it's really a skill, but everybody who, if you think back to your childhood and your bartering stuff, that's the way you kind of need to think. Even with customers, in my startups, my packaging startup, I didn't have an R&D department. I really needed one. But I didn't have the $1 million to go hire the people and set up the labs, so I bartered some deals with suppliers to use their R&D labs, and that was enough. So that's kind of how you get started. And if I'm going kind of fast, I apologize, because we have an hour, and some of these I can spend an hour on one bullet. So bear with me. All right. So that's kind of helps you coming out of a big company or big co. Some things you're really good at, keep doing, do more of, and some things to watch out for. There's some tips here. A couple of questions, which I found really helpful, and I'll look at it from one of two ways. You know that finding paying customers is the fastest way through the temporary startup phase. What do you have to do to get that? Well, I'll give you two perspectives. When I was at Procter & Gamble in the Connect and Develop, and I talked to inventors every day, and I was buying patents. I was buying small companies for P&G at the time. And investors do the same thing. We had the same 3 questions we asked everybody in the first couple of minutes. Every inventor, every small company that wanted to sell P&G some kind of technology. What's your intellectual property and how have you protected it? Do you have a working prototype, and have you sold anything? Sort of plain English, anyone can get that. That's actually that actually implies a lot of wisdom in it. And let me show you what the Lean Launchpad theory says, so you can see the similarities. But although the language is different, Lean Launchpad would say, "What's your business model hypothesis?" So basically, that's a description of what product are you selling and what's your business model, including how does that protect it. So that's what that first question is. It's a very similar question. The second question, do you have a minimum viable prototype versus a working prototype? Same thing, different language. And the third one, did you confirm your hypothesis with customers in Lean Launchpad? So did you sell something? Because that's the only way you know that your business model actually will work, is a third party buys something. So these 3 questions, if you just kind of keep those in mind, what's my hypothesis? Do I have a prototype, and have I sold anything? Will help. It's kind of based on the scientific method, right? Hypothesis testing. It's not only theory, but it is what big companies and small use, and it's kind of wired in the DNA of people who do this over and over again. Let me talk a minute about prototypes. First-time folks, particularly if they have a technical background, overbuild their prototypes by a lot. And I'll borrow a story I heard elsewhere. A company was doing, their idea was, we're going to take drones and put cameras on them, and we're going to fly them over farmers' fields and take pictures. And then we're going to post these pictures every morning, some early hour, and the farmer can pull them up and see how their fields are doing. Do they need more water? Do they need weeding? What do they need every day? And then eventually we'll build some artificial intelligence that can rate the pictures, et cetera, et cetera. So they were off looking for hundreds of thousands of dollars of startup funds because they wanted to, build a drone and attach a camera on it and fly it over and post results and then get some farmers to test it. Well, there are certain parts of that business model that are key and other parts that are pretty much everyone can do. So the question was, are you trying to prove that you can build a better drone? Do you need the $200,000 to build the drone and attach the camera? Well, are you trying to prove that you know how to build cameras? Are you trying to build that you know how to build drones? Because there are people doing that really well already. What is it you're trying to prove? You're trying to prove that pictures taken from high up and posted on a website are useful, and somebody will pay money for that. That's what you're trying to test, is pictures taken from high up are useful. So what they were advised to do and wound up doing was put cameras on long poles and then walk through the fields, taking a picture every so often and then posting those, and then seeing if somebody would pay for that. Once they had people paying for that, then they could start worrying about attaching cameras to drones, and etc. So the prototypes, the minimum viable prototype concept is only to test the part of your business hypothesis that is where the value is being added. It's the new thing. It's the new wrinkle. So it's sort of the idea is eliminate everything else because everything else costs a lot of money, and just test the part of that's different, that the customer views as different and valuable. Again, I've done a whole day on minimum viable prototypes, but you're trying to keep you're trying to move quickly through the temporary startup phase, and prototypes do help. I have seen people get purchase orders based on a prototype that was nothing more than basically 10% of the final product, but it was the part that was different. I also advise people when they're doing pitches, and as a pitch judge, that if you have a prototype of some sort, and it's a good one, a simple one, that instead of like getting up and explaining your business and how you're going to be $50 billion someday and why the team is the most amazing team, there are some common themes in pitches. Get up and show your prototype at working, and then show the customer working with it. And if it's 30 seconds or a minute, that's far more convincing, and it works great with investors. It also works great with potential customers. So that's the 3 steps. If you had to skip one, skip the prototype. Keep the hypothesis and keep talking to customers until you've got somebody who wants to buy something. And that'll keep you on a productive path through the startup phase. Another watch out, and this is a big one, don't forget profit. I see a lot of folks get up in pitch competitions and say, I found a customer who has this amazing pain point, and they're just willing to pay anything to get it fixed. So I'm creating all this value. Isn't this great? Give me money for a startup. And I built a prototype, and et cetera. So that's good. That's kind of what everyone does intuitively. What most people leave out, especially the first time around, is, okay, you're going to create a lot of value. How is your startup going to capture that value, as opposed to somebody else, or as opposed to, like, you didn't really think through the buying process? So I'll give you some examples of products that solved a big problem. They had lots of data that worked, and they'd gone out in the field and tested it. But there was a problem. Like, how is the startup going to make money? So in the healthcare and education markets, I see this. It's actually the norm in pitches, that they get up there and explain the problem, their solution, and then I'll raise my hand, or somebody, and ask the question, is there an insurance code for that if it's a healthcare product? Because if there's no insurance code, the insurance company is the one that pays for the product, and if there's no insurance code, there's no way of getting paid. And if there's no way of getting paid, then no one's going to buy it. And insurance code can take years to get. So that's one of those things where they didn't quite think through the how is my company going to capture value, because I didn't think that the patient loved it, but who's going to pay for it? Same thing with educational products. They go out and test it with young kids. They can read faster. That's all good. But the problem is they didn't test it with school boards. They didn't test it with teachers. And if teachers don't like it, if school boards don't see a good return on investment, no sale. That's a long process. So I'm really careful when I look at healthcare and education markets for those reasons. Another one is, and then this is true of big companies, everyone I've ever talked to, and that is when startup comes in, they start pitching their big idea. And you think, wow, that's really cool. I hadn't thought of that. That probably work. We could probably use it. We'd probably buy it. What the big company's probably also thinking is, when in my packaging startup, I had a green package. It was greener than anything else and cost effective. And I know what they were thinking is, I really love this. I'd probably like to buy some, but I'd probably like to buy it from International Paper, not from Stuart's startup. Because I don't know Stuart. I just met him yesterday or whatever. So they're going to go to their suppliers and say, hey, I saw this cool idea. Can you make this for me? So when you're thinking about how your startup's going to capture value, you want to think about you're solving this wonderful problem, but how is your startup going to make money, and why are customers just going to go to their suppliers and get it? In fact, customers often prefer going to suppliers over startups. Remember, it's risky. And then another case, multi-sided market. So, I'm going to match contractors who work on homes with homeowners. I'm going to charge a small fee, and it'll be great, and we'll just take off. Okay, that sounds good, but the problem is getting that started. You have to have enough contractors to make homeowners interested and enough homeowners to make contractors interested. So you need sort of both at the same time. And they don't have a credible story how they're going to get the whole process started. So again, if you can't get the process started, then you can't capture the value. So don't forget that profit. The solving value for value, people are really great at that. Capturing the profit, in my experience, that seems to be harder because fewer people have a great story in that area. And then I'm going to talk a little bit about managing scale. This is another thing that's different about big companies. And I'm going to tell you a story of a friend of mine. At P&G, we'd come up with a new invention and then have a marketing budget of tens of millions of dollars. We would set that aside, get that approved. We'd build a plant that could supply the entire North America, and on a certain day, we would turn the advertising on, launch, ship everything to Walmart and every other store, and have national distribution overnight. So that works for big companies. That's the way they do it. A startup just can't do that. You should think big and start small, and just to be more realistic. And when I think big, let me just break that down. Think big. In many cases, the startup's ideas aren't big enough. So it's usually, I'll see a product that somebody says, I've got a technical product, it works 10% better than what's already out in the field. I did one on a computer touch displays for cell phones and iPads. It was 10% better than what was out there now. The problem is companies have spent billions of dollars building plants that makes the current product. And nobody's going to switch over to a new technology for 10% better. So not 10% better, it's more like 10 times better. If you're doing exactly the same thing that's already out there, it has to be dramatically better, usually. Or you're coming in with a totally unique solution, or just it's so different from anything anyone's seen before, there's no mistaking it, and people will jump over to your product because of it just does something that nothing else does. So when I say think big, probably think, for most startups, look at your pitch and then try and think even a little bigger. And then secondly, now you're done thinking big, but realize you can't start big. You just don't have resources. You don't have tens of millions of dollars for advertising. And one of my friends found this out. He launched a beauty product, and he talked Walgreens into, he was a former P&G person, talked Walgreens into stocking it in several hundred stores. And Walgreens and Walmart are actually easier to talk into trying something than you would expect. So they said, yeah, well, ship us this much. So he makes a major financial commitment to go build enough to stock 500 stores, and they ship it all off. And it sits on the shelf, and it's a beauty product. And you know what beauty products look like at Walgreens? It's a very crowded space. It's hard to find anything. And sure enough, 10 weeks later, the Walgreens looks at the sales of this new product, and it's not moving because the main reason is nobody knows it's there. There's no marketing budget behind it. It's a very crowded space. So after 10 weeks or so, Walgreens says, well, it's not moving. They take it off the shelf and ship it back. And because some of these big retailers don't pay for 100 days, they haven't even paid for the stuff that was in the stores when they shipped it back. So the person makes a big financial commitment, they get it on the shelf, and before they even get paid for it, it comes back. And now they've got in a lot of trouble because they have no sales and they've leveraged themselves to build a product. So you start too big, that's the kind of thing that can happen. It's usually when you're in the startup phase, you want to think really small, and a lot of times in consumer products, that means like online sales. Start with online sales. And you don't need a big budget, or you just think of like, I've got a food solution, I'm only going to try it in local restaurants for a while, or specialty stores. And what you're trying to do is take a really small niche of a larger market and create a little tiny echo chamber where customers are talking to you, talking to each other, the feedback builds, and you can prove that it's working. And there's a certain math that goes with that the first customer is by far the hardest to get. The second, it's only half as hard because you can mention that you've already got the first customer, and the third half again is that, etc. So you're trying to create this tiny echo chamber and then build out from there rather than boil the ocean and mass market launch everything. And it gives you that approach gives you time to sort out and manage product improvements, quality control, pricing refinement, supply chain, and to tweak your business model, which in nearly 100% of the cases doesn't survive perfectly from your original vision, and that's a good thing. And then one other important thing, if you're doing something that a large competitor could copy and come in later, starting really small and getting your model right, that way staying under the radar delays the competitive reaction. So you've got more time to really get yourself established and get a good story before the big players come in, and that running start can make all of the difference. So that's sort of scale, and again, coming out of a big company, think bigger on the long term and think smaller like next week, and then learn fast. Speaks for itself. Okay, now the last part of it, I want to talk about some sort of general trends. Maybe we'll tie together some of the behaviors I've been talking about with some industry data on what really, looking back on venture capital companies, and some data on what has worked and what hasn't. So I'd like to do poll number 3. Lucy, if you'll cue that up. That's a poll on what drives startup success.
Sure. Just so that I don't leave the poll up too long, can you let me know when you want me to take down the poll so that you can be back on your screen? Thanks.
Sure.
Okay, I'm about to close the poll and share the results.
Okay. Well, this is an audience that has been doing the reading. 59% say the team and executive is the most important factor. Second is business model. The idea is only 4%, and timing. Okay. You guys have been doing your reading, and that is fantastic. Lucy, you can take the poll away now. Most folks who've never read anything would say, well, the idea is the most important thing. And often when I'm on talking to academics, which is where I spend a lot of my time looking for the next big idea, they really think the idea is everything. When I lease things from universities, generally speaking, we don't give more than 10% of the value of the startup to the inventor. Because the inventor's not going to play a part in the company long term. The idea is only 10% of the value of the rest of the company, and that's kind of it. You guys said 6%, so you're actually pretty good on the idea. That's not the most important thing. Let me switch ahead to a survey that Bill Gross, the founder of Idea Lab, did and presented in a TED Talk of 200 companies, 100 that had gone through Idea Lab, and these are all investment grade companies, and 100 from across the industry. And what he found was 42% were their success was related to timing. And I'm going to agree with that. Timing's out of your control, but I'm going to tell you what happened my first 2 startups. My first startup, I launched with 2 ad executives, and our idea was, it's more than 10 years ago, we were going to stream network television over the internet. It hadn't been done. We were going to do it all in one spot, so you could get all the channels and basically, replace cable TV. So we started doing that and going to New York and having great meetings, etc. And then one day, after about 6 months of this, everybody's really interested And we're well on our way to be the next Mark Cuban, right? I mean, Mark Cuban made his $1 billion streaming high school football games on the internet. We were going to do, like ABC, NBC, and wow, wouldn't that be great? So we're cruising along, and then one day I pick up the Wall Street Journal and see that General Electric has funded a new joint venture with Disney, ABC, and NBC to stream network TV over the internet. It was called Hulu.com, and that day they put us out of business in about 24 hours because the big guys came in and took the space that we were hoping to get, and we were done. So timing, we were a little bit too late getting started on that. Had we started 2 years sooner, maybe in a different outcome. So that could happen on the bad side. On the good side, the next thing I did was a green packaging company. So we were doing basically cereal boxes made out of agricultural waste, very green. Started it in 2009. Around 2011 or 10 or 11, all of a sudden having greener consumer products became the hot thing. It was all anybody seemed to be talking about in consumer products. And here I am with a greener package right in the middle of that space. So in 2011, 12, 13, we just really had an easy time of it. Sold the company in 2013 and went on to do other things. So when Bill Gross gets up and says timing is important, I mean that's my life. But unfortunately, I can't control that, so you can't do it. The next thing is team and execution. You get the right team, and the team goes out and they have an idea, they have a business model. Those are both hypothesis, and they're going to go out and test those combinations of features and pricing points and delivery against the market, and come back and figure out how to balance everything, and then how to validate all those hypotheses and get the company going. So good job, folks. The only thing I think you guys learned out of this was that timing matters. Doesn't really, knowing that it doesn't really help because you can't control it. So it is important to have multiple turns at bat. And important to not spend too much time in the startup phase, because if you've got a failure, it's super important to shut it down and move on to the next thing. All right. So I've got a little suggested reading for folks who want to dig in a little more. This is, except for the blog, steveblank.com blog, the rest of these are a little bit heavy reading. But if you want to get into the startup scene and you only could read 4 things, this is what I'd pick. And there's my contact information if anybody would like to chat more about startups, bounce ideas. I love doing this, and I would be happy to talk to you. So with that, I think I am ready for some questions.
Great.
Lucy.
Yes, absolutely. There's somebody, the first question that came up, they must read my mind, because the next webinar that we're going to be doing in 2 weeks is having an alum who is an attorney who works with startups. So you might want to stay tuned for that one. The question is, how do you advise a startup, how much do you advise a startup to hire a lawyer or a firm? Do startups get jammed up later on because they didn't have the employment versus contractor agreements, patents and trademarks, appropriate sales and supply contracts? Seems like a trade-off between cover key risks versus moving fast and being focused.
Wow, there's a lot in that question. I want to say it depends, but I think it's an 80-20 kind of depends answer. There are 20% of startups I see, the answer is yes, go get a lawyer. You have invented the cure for brain cancer, and it's a new molecule the world's never seen, and only you know how to produce it and administer it. Yes, hire a lawyer. Your entire business model rests on that patent, and you know that people who have brain cancer will pay you whatever. So that's the 20% answer of startups. And here's the other 80%, and most people do too much with lawyers. The other 80%, they've got an idea that it's a new product, but it's just not, it's not clear what the market is yet, or it's and that happens a lot, or who's going to buy it, etc. You know, you might want to file a patent, maybe, but you might want to go out and find if there's somebody willing to buy this. And for 80% of them, I'd say no. Here's some things you got to do early on. You got to figure out who might buy this and why, and then you should start setting up these interviews. We call them in Lean Launchpad customer discovery interviews, which are a little bit more like therapy than they are a sales call, because you don't have anything to sell. You haven't started the company yet. You're meeting with potential customers and saying, I'm thinking of doing something, and describe it very generally so you don't give away all the trade secrets. And then say, you have a problem in this area, and see if you can get people to talk to you. You may have to make a lot of phone calls to get that, but you can get that information. And if people come back and say, there are 4 things I look for that is like a home run in these early interviews, and here's what you're looking for. The person clearly can describe their problem, the potential customer, and what the solution would look like. So that's the first one. They've got a problem. Second one is they have some idea what the solution would be. The third level you're looking for, and these are kind of getting increasing importance. Third level is they've been shopping for a solution. So they're actually out calling up companies and talking. That's a level of interest that's getting pretty high now. But the ultimate is they're out shopping for things. They're not satisfied with anything that's on the market. So they built a homemade solution to solve their pain. But it doesn't work very well. And they would certainly buy something that worked better. So when you're out talking to folks, you can do your market research without having to get patents or hire lawyers that way. As far as the employment front, that's where I talked a lot about personal integrity. The more contracts you have, my experience, and I'm not a lawyer, this is just my personal experience, the more contracts you put in front of people early on, especially when you don't have money to pay them, the more likely they're going to quit, and the more likely they're going to sue you later. A lot of it has to do with building relationships with people, telling them up front, I'd like you to work for a while with me, some period of time. I can't pay you, but could you spend 2 months to do customer discovery? No promises, etc. So I generally don't hire lawyers to do all that. I know there's different approaches, but a lot of those things can be done in a few weeks. And what I want to know more than anything is, is there a market there before I start spending a lot of money? Most of the time when I do this customer discovery, I found out there's really no market. People don't care, and I can move on to the next thing. Sorry, that was a long answer, but
that's okay. Some of the questions are pretty long too. No, but it's good. I like seeing the long questions because it means that people have thought about it. Any guideline on the mix of founder to employees with deep experience and skills versus less experienced people who are just plain smart, go-getters, flexible? Mm-hmm. There's more to this, but I'll stop here.
Yeah. I will give you, I will tell you a story. It's a short one. The packaging startup I talked about. I was building a paper company, and I was going to, food companies that used, huge amounts of lightweight boxes, the kind I sold, the greener box. And I thought, man, I need a lot of help here. The local Cincinnati, Ohio area is full of former paper company executives. International Paper's U.S. headquarters is here in Cincinnati. So I had a lot of people with 20, 30 years experience, and I interviewed many, many people. And I would tell them what I'm trying to do, and most of the time, somewhere in the conversation, they would say, well, that's an interesting idea, but that's just not going to work because that's not the way International Paper would do it. And then they would proceed to tell me why, my business model was stupid. Okay, I never hired those people because they were going to wreck my business. In that case, industry experience was actually a bad thing, and that unfortunately can happen a lot. So, I think having an introduction to an industry is a good thing. If you have to have 30 years of experience to launch your startup, your idea probably is not a very big one, right? Because you're just kind of doing what people are already doing. So a little bit of experience and a lot of flexibility is what I look for, and that's my bias.
Great. Speaking of selling to prove the demand price, what do you think of crowdfunding to test the market, price, etc.? What are the key benefits of versus potential downside of crowdfunding?
I love this. I just did one of my companies I'm an advisor for just did a Kickstarter campaign last month. We were successful, so very timely. I loved everything about crowdfunding. This was a product that, if yours fits the thing, it was a product that didn't have a patent, but it had trade secrets. So it was a film on a substrate, and there was no way to tell how the film was made once it was made. So you didn't have to worry about people copying your thing. You just ship the substrate with the film on it, and that was it. So he crowdfunded the whole thing, and I helped. And in that case, it was really a case of the people who funded the product. They were just basically buying it. It was a consumer type product. It was about a $40 to $100 price point. The people who were buying the product were also giving a tremendous amount of advice. That the chat rooms were full of people buying the thing and saying, oh, by the way, you should make this a different color, a different size. What about this other material, etc. You sort of get free market research from paying customers, which is the best kind, and money all at the same time. So for simple products that are consumer friendly, I think crowdfunding is fantastic. Again, if you're trying to do brain, solve brain cancer, probably not. Something that's not ready to ship almost, in the next few months, etc. And you have to be able to describe your product pretty well, and you have to be able to ship it in a reasonably short amount of time. But if you can do all of those things, I think crowdfunding is fantastic. And you don't have to give up any equity, to get the cash. You're basically pre-selling things.
Great. Can you share the pros and cons on confidentiality versus stealth mode for a startup?
Well, repeat the last. Confidentiality versus what?
Sorry, I misread the question. That's my fault. Pros and cons on confidentiality or stealth mode for startups.
Stuff mode? Is that what you said?
Stealth.
Stuff mode. Okay.
Stealth, where you're hiding something. Stealth, like the stealth bomber.
Okay. Stealth mode. I'm sorry. My connection was not perfect. Yes, confidentiality. People stay in stealth mode. There are always an exception, and somebody will, on the phone call, will know what it is. But that's the exception that proves the rule. In most cases, people spend way too long in stealth mode, and they should. My advice is, go out and do your market research and your early sales. And people say, well, I can't because I'll give away confidential information. I would challenge that. In almost every case, I've said, tell me what's confidential about your thing, and I'll tell you how to say that in a way that you don't give away all your secrets. You can give people a general idea of what you're doing without having to tell them how to do it. And folks think, oh, well, if I tell them, especially engineers, if I tell them something, I have to tell them everything because I'll get questions. No, you don't. You can just say, this product cures acne. And they can say, well, how? You can say, by rubbing it on your face, okay? There are always simple ways of describing things that give you enough information, or consumers enough information, to make a decision on whether or not they might buy something without giving away the store. So I would say don't tell people how to mix up your special acne medicine. Don't tell them the formula, but do tell them that it solves acne by rubbing it on your face. And if they just look at you and say, well, I need to know how it works before I can make a decision, they're probably not customers, to be real honest. They're just curious. And folks, the thing I found about doing approaching potential customers with a startup idea is that, especially in the Midwest, folks are polite, and they're really nice to you, and they know that you have a really uphill road ahead of you, and they don't want to give you bad news. So companies will say all kinds of things, and they'll ask a lot of questions, and it's really easy to get a meeting. I got everyone I called said, I've got a greener package. They say, great, come to Minneapolis, come to Chicago, come to New York. Everyone. It was super easy to get a meeting. It was really hard to get a big purchase order. So kind of going off the track a little bit, but the point is, you can describe what you're trying to do in enough detail, probably, by just describing the benefits, and you can go out and do the market research, and you should. So, and stealth mode, I think, is a bad idea, because for most companies, you need to tell a lot of people about what you're doing. How else are you going to find co-founders and potential customers and investors, which was the oxygen for your startup without telling a lot of people. So you're kind of trying to find needles in haystacks. So you got to tell a lot of folks. Hope that helps.
Thank you. I know there are a lot of questions out there, but I want to be cognizant of everyone's time, including Stuart's. So what we're going to do is I'm going to ask everybody who had a question for Stuart to contact him directly, if you don't mind, and you can list all your questions. I'm sorry, yeah. Stuart. It's just that we have a hard stop at 1 o'clock.
Yeah, I would love that. And just make sure and tell me in your early on that you heard this at the University of Chicago webinar. So I know when you send me your question, I'll know how I know you. So okay.
Right. Thank you so much, everyone. I really appreciate it. Just want to have a special thank you to Stuart for giving his time. He's done tremendous, as you can see, a tremendous amount of work for me for free, and I greatly appreciate it, and I appreciate everybody's questions and answering the polls. I want to let everyone know, and I mentioned this briefly, that we're going to be sending out the slide deck, so don't worry, and we're also going to be sending out a link to the recording, so you get that as well. That's good. Probably going to be in the next day or so. The next webinar is August 22nd, and you're going to hear from college alumnus Justin Agans. If you'd like to hear from and ask a question of an attorney who specializes in startups, that's the time to do it. Thank you again for joining, everyone, and have a good rest of the day. Bye.
Bye-bye.
Bye.